everyone, Dan Eisner here from ZLC Employee Benefit Solutions. Welcome to this episode of my Better Benefits podcast series. I put these podcasts together based on my passion to find better ways for employee benefits. And I do this by leveraging my relatively unique profile, having almost 25 years experience as an employee benefits advisor, and being the only chartered professional accountant working in this industry in the local market. In this podcast, I want to talk about the apparent mystery that often exists for plan sponsors around how their employee benefits premiums are calculated. Unfortunately, it's often the advisors that create this mystery, but I'm here to help demystify much of it. Okay, let's get started. So at ZLC Employee Benefit Solutions, when we meet with potential new clients, we often encounter confusion around how employee benefits plan premiums are calculated. Too frequently, our initial conversation is explaining that there really is no great mystery or secret around how these costs are calculated, albeit there is some fancy math. The real issue is that the underlying insurer methodologies have not been broadly discussed, and therefore many plan sponsors have not been educated by their advisors on how it all works. Worse is that many employee benefits advisors and brokers have convinced plan sponsors that you can simply reduce benefits plan costs by changing insurers. Pause to think about that. How many times have you been told by an advisor that they can reduce your costs by 10% or 20% or even more if you make a change in insurer without actually explaining how that is going to happen? Advisors that make promises without spending much time first understanding things like your employee demographics, your plan design, your underwriting methodologies, your expense charges, they can't make an informed assessment to back up a promise for a reduction in claims. At the end of the day, your employees and your benefit plan design predominantly drive your plan costs, regardless of which insurer you're with. If you're considering a new insurer, note that the underlying cost of your employees' claims should not differ much, provided that your employee group and your plan design details remain the same. Based on our experience, there's typically no more than a 0.5% difference at most between insurers in adjudicating the actual claim costs. And these differences are often driven through things like, for example, lower reasonable and customary charges applied to some claims costs. When insurers offer you savings, you need to understand whether those savings are sustainable in the long term or just short-term discounts that'll evaporate in a year or two. So with these factors in mind, please be assured that there are still ways to generate sustainable savings in the long term, but you need to know how they work. First, your advisor needs to communicate to you what the underlying manual rates are for your pooled insurance benefits. And I mean things like your life and long-term disability benefits. Then you need to confirm how the insurer sees the underlying risks related to these benefits for things like your employee demographics based on age, gender, earnings, industry, occupations, things like that. Note that there can be significant differences here between insurers. And now for your more costly benefits, extended health and dental, your advisor needs to communicate to you what the target loss ratios are for these experience rated benefits. These ratios effectively confirm the expense charges being applied by the insurer in calculating your premiums. And again, there can be significant differences in the size of these expense charges. Correctly assessing the underlying competitiveness of manual rates and target loss ratios ensures your ability to bend that cost curve in the long term. Advisors that do not present this information and explain the cost implications likely don't have the data to benchmark the competitiveness of these factors and assess their sustainability in the long term. Instead, they simply grind the insurers for short-term marketing discounts that will simply evaporate at the first and second renewals, and you'll be back to where you started, or possibly worse. At ZLC Employee Benefit Solutions, we do it a bit differently. We're proud to have the most experienced team in the local market with lots of specialized underwriting skills. And we routinely educate our clients on how their plans are rated and confirm how their premium rates are calculated. Okay, you've heard my thoughts and opinions, so please let me know what you think. Was this advice helpful? How does it compare to what you're hearing from your current advisor or other advisors that you've dealt with in the market? As well, I'm always interested to know if there are other current topics that you'd like to see me cover in future podcasts. Let me know what's bothering you, keeping you awake at night with respect to your employee benefits plan. Thanks for joining me today. Be sure to follow me on my LinkedIn business page. That's Dan Iser, Employee Benefits Advisor, and you'll get notifications on the next Better Benefits podcast. And all that information will come up on the screen in a second. Thanks so much.